Money laundering, it sounds like something out of a movie. Suitcases of cash, shadowy figures, offshore accounts, and a race to hide the origin of dirty money. But in reality, money laundering is a complex, evolving business model used to hide profits from crime so they can be used in the legitimate economy. In the next 12 minutes, I'll walk you through the core mechanics, the major types of schemes, how they've adapted to modern finance, including crypto, and how governments and institutions try to stop them. This is a high-level explicable. We'll cover concepts, patterns, and red flags, but not the nuts and bolts of how to commit crime. Let's get into it. At its heart, money laundering solves one basic problem: how to take cash or proceeds generated from illegal activity, drug trafficking, fraud, corruption, tax evasion, human trafficking, and convert it into assets and transactions that look legitimate. To do this, criminals follow a loose three-stage model that law enforcement often uses to analyze laundering: placement, layering, and integration. Placement is the initial introduction of illicit funds into the financial system. This is the riskiest moment. Raw cash, suspicious transfers, or obvious proceeds have to be made to look normal. Historically, placement looked like depositing bundles of bills into bank accounts, using casinos to cash chips, or hiding cash within a legitimate business's daily receipts. Because large, unexplained cash deposits trigger alarms, criminals develop techniques to hide amounts, move money across many small transactions, or use third parties to do the placing. Layering is the obfuscation stage. Once funds are in the system, the goal is to create distance between the money and its origin. That means many transfers, conversions into other instruments, purchases and sales across jurisdictions, or routing via complex corporate structures. Layering exploits gaps in oversight between banks, jurisdictions, or financial products. The purpose is not to make money grow, it says to make the money trail muddy, inconsistent, and hard to trace. Integration is where laundered funds re-enter the legitimate economy. After sufficient obfuscation, proceeds are used to buy houses, businesses, luxury goods, or invested in legal ventures. When done successfully, integration creates the appearance that the wealth was always legitimate, and that creates profit, status, or political influence for the criminal group. Those three stages are a useful framework, but the specific techniques are many and constantly changing. Let's look at the major scheme types you'll encounter in reporting and prosecutions. First up, structuring. Structuring breaks large cash deposits into smaller amounts to evade reporting rules. Smurfs are people paid to make those smaller deposits at multiple branches or on different days. Regulators watch for patterns. Many small deposits from the same source into many accounts is a classic red flag. The technique is old, simple, and still used because cash is a universal medium. Next, trade-based money laundering (TBML). This one is deceptively simple and notoriously hard to detect. TBML uses international trade transactions, invoices, shipping documents, and commodity sales to disguise value flows. A company might over-invoice or under-invoice for goods, ship low-value items but declare high value, or create fake shipments altogether. Because international trade involves multiple parties, customs authorities, and different rules per country, mismatches in price, quantity, or description can mask large illicit transfers. Detecting TBML requires comparing trade data across borders and looking for price, weight, and pattern anomalies. Shell companies and nominee directors are another mainstay. A shell company is a legal entity with no substantive operations, created to receive and transfer funds while obscuring the beneficial owner's identity. Nominee directors are people who lend their names for a fee. Criminals layer funds through a web of these entities across jurisdictions with lax disclosure rules. The paperwork looks legitimate, the ownership doesn't. Investigations often rely on leaks, cooperative jurisdictions, or whistleblowers to peel back these corporate veils. Then there's real estate laundering. Property is attractive, it stores value, often appreciates, and can be purchased via complex trusts or companies. Launderers buy high-value real estate with illicit funds, sometimes pay cash, renovate, then resell or rent. Because property transactions can be opaque and jurisdictions differ on beneficiary disclosure, real estate remains a major channel for integrating dirty money. Casinos, luxury goods, and art markets have long been used for laundering. Casinos convert cash into chips and back into winnings. Art and luxury goods, high-value, portable, and subjective in price, can be bought and resold with little transparent pricing. The art market in particular has weak price discovery and confidentiality, making it attractive for hiding origin and moving value internationally. In recent years, virtual currencies and online platforms have become significant. Cryptocurrencies offer speed and pseudo-anonymity. Mixes and privacy coins aim to further obscure flows. Criminals convert cash into crypto, move it through multiple wallets, use decentralized exchanges, or obfuscate transactions via mixing services. Exchanges that don't enforce Know Your Customer kick rules make this easier. Authorities have responded by tracking blockchain transactions, working with exchanges and regulating the crypto sector, but the technology's borderless nature remains a challenge. Related to crypto is peer-to-peer and fintech risk. Mobile money, e-wallets, prepaid cards, and payment apps can be used for placement and layering. Small transfers between many accounts, or rapid conversion between fiat and digital currencies, can replicate classic smurfing on a digital scale. Fintech speed can outpace regulatory monitoring, so compliance remains a cat-and-mouse game. Professional facilitators, lawyers, accountants, bankers, and company service providers can be willing or unwitting enablers. Their expertise in corporate structuring, trust law, and asset management can help launderers build credible facades. Many anti-money laundering (AML) laws therefore impose duties on these professions to verify clients and report suspicious activity. So how do authorities fight back? A combination of regulation, data analysis, international cooperation, and enforcement is used. Financial institutions are required to operate AML programs. Customer due diligence, KIC, transaction monitoring, suspicious activity reporting, SARs, and record keeping. Banks use algorithms to flag patterns, rapid transfers, round-number deposits, or unusual cross-border flows. Regulators also require large cash deposit reports and cross-border currency declarations to catch placement. When financial institutions detect suspicious activity, they file SARs with national authorities. Those reports are often the starting point for investigations. On the regulatory side, groups like the Financial Action Task Force (FATF) set international standards, publish typologies, and evaluate countries' AML systems. FATF graylists and sanctions can pressure jurisdictions with weak controls. Mutual legal assistance treaties and joint task forces allow cross-border investigations and asset seizures. Modern investigations increasingly leverage data analytics, trade data matching, and even leaked documents to trace complex schemes. But detection is hard. Launderers exploit fragmentation, different legal systems, thresholds for reporting, secrecy jurisdictions, and a constant flow of new technologies. That's why transparency measures, beneficial ownership registries, stricter due diligence for high-risk sectors like real estate and art, and closer oversight of non-bank payment providers are central to current reforms. There are also human and ethical angles. Money laundering funds harms. It fuels organized crime, corrupts public officials, distorts markets, and undermines democracy. Law enforcement seizures of criminal assets are not just about punishment. They disrupt criminal networks and can provide restitution or victim support. What are the signs ordinary people or businesses should watch for? Be cautious when asked to accept or move money for strangers, to open corporate accounts for unknown beneficial owners, or to accept unusual payment patterns that don't match the stated business activity. If you run a business, strong invoicing practices, clear record keeping, and asking uncomfortable questions about the source of funds are essential. Professionals like lawyers and accountants have legal obligations to report suspicious client activity, and failing to do so can have severe legal and reputational consequences. Finally, let's talk about the future. Technology will continue to change both sides of the ledger. Machine learning and big data will make AML systems smarter, better at spotting anomalous behavior, and able to analyze trade and ownership data at scale. At the same time, encryption, privacy tools, and new value transfer systems will create fresh laundering avenues. Policy responses will need to be nimble, better data sharing, harmonized regulations across jurisdictions, and a balance between privacy and transparency. To wrap up, money laundering is not a single trick, but a toolbox of techniques aimed at hiding criminal proceeds. The core pattern, placement, layering, integration remains constant. But the instruments change: shells and trade, casinos and art, real estate and crypto. Stopping it requires cooperation between banks, governments, tech companies, and ordinary citizens who refuse to be unwitting conduits. Understanding the schemes helps society identify risks, protect institutions, and reduce the corrosive influence of illicit money. If this topic interested you and you want to follow up, I can make a shorter explicable on how AML systems detect suspicious behavior, or a primer on the role of beneficial ownership registries and how they're changing the game. Remember, knowledge is power, especially when it's used to protect legitimate finance and communities from harm.